Hello traders, in this video we are diving into a simple yet powerful method called the 5-minute breakout strategy using ADR levels plus pivot points. Alright, so if you are looking for a clear, actionable way to identify breakouts and time your trades, then this video is for you. Stick around because I'll break down every step, so by the end you know exactly how to use this strategy on your charts. First of all, we have to talk about ADR levels. All right, ADR stands for average daily range. Okay, average daily range measures the average movement of a currency pair in a single trading day. All right, it measures the average movement of a currency pair in a single trading day. Knowing this helps you gauge how far price can realistically travel, which is essential for breakout setups. Now, to calculate your ADR, you simply take the difference between the daily high and low over a set period. As you can see, this particular indicator uses a default length of 14. All right, so typically is the difference between the daily high and low over the last 14 days, right? Over the last 14 periods, and you average it out. Okay, so once you know your ADR, you mark the upper and lower levels on your chart. These are potential targets or zones where the price may react. Okay, but that's if you are doing some manual calculations, right? If you're making use of this indicator, then of course the calculation is done automatically, and it is calculated based on a default length of 14 periods. Of course, you can edit this length depending on the number of periods that you want the calculations to be done on. All right, and then you take note of the values of the indicator at any given time. Okay, now pivot points are very important. Okay, they are critical support and resistance levels calculated from the previous day's price action. Pivot points give you a roadmap of where the market might stall, reverse, or continue. Now let's also check out for pivot point indicator. Indicators have made things easier, right? Instead of doing some manual calculations yourself, you just make use of indicators that do the heavy lifting for you. All right, so I think we should be using a pivot point that is more detailed. All right, let's try out the pivot point standard. Okay, let's just go to a lower time frame. All right, so now there are several levels. Okay, there are several levels when using pivot points. All right, we have the main pivot point, all right, which is P. Okay, and we have support 1, which is S1. We have support 2, which is S2, and we have resistance 1, which is R1, resistance 2, which is R2. Okay, then of course you might have more support levels and more resistance levels. All right, so for the 5-minute breakout strategy, we are actually focusing on the main pivot point and the first support and resistance levels. All right, so when price approaches these points, it often accelerates or reverses, creating the perfect breakout opportunity. Now, here is where the strategy comes together. By combining your ADR levels, with pivot points, you are identifying areas where breakouts are most likely to happen. If the price breaks above a pivot point, All right, if price should break above a pivot point, let's say this now, for example, and around that time, perhaps your ADR value is low. Okay, if you have the price break above a pivot point near the ADR, okay, when the ADR value is high, actually, all right, you have an upward breakout, all right, upward breakout near ADR high, it signals strong momentum. Conversely, if price should break below a pivot point near ADR low, that's your short setup. Okay, so you want to look out for upward breakouts around high values of ADR. I want to look out for downward breakouts around low values of ADR. All right, so using both tools together filters out false breakouts and gives you a clear visual of potential price action. Now, timing your entry is crucial on the 5-minute chart. You have to wait for the candle to close above or below your pivot point zone. All right, your pivot zone to confirm the breakout. Avoid jumping in too early. Patience here makes a big difference. So once you are in the trade, the ADR levels act as your target zones. All right, for stops, you can place them just below the pivot. Let's say you are hopping into a buy trade, right? After you had this breakout from this particular level, and you hopped into your buy trade, perhaps you can be targeting maybe the ADR level rising up to this zone. This is just an example, all right? So using this ADR levels as a reference point for your buy trade, okay? Then for your stops, you have to be, placing your stops below pivot, pivot points for long trades. Like let's say you are entering a buy trade right about here, your stop should probably be below this pivot point, right? This particular pivot point, and then your take profit can be open-ended, or you can actually use a reference point here while still waiting, or rather using your ADR levels for confirmations. All right, because when you find the ADR value rise to a particular high, then it could be a sign for you to manually exit your buy trades. Then the reverse is the case for a sell trade. Okay, your stops should be placed below the pivot for your long trades and above the pivot for your short trades. So this keeps your risk tight and your trades organized without cluttering the chart with too many indicators. So that's the 5-minute breakout strategy using the ADR levels plus pivot points. Okay, it's simple, precise, and it's worth trying out for short-term setups. All right, if you found this helpful, don't forget to like this video, subscribe, and hit the notification bell so you never miss a new trading strategy. Remember, using ADR and pivot points together gives you an edge in spotting breakouts efficiently. You can try this method on a demo account first, to see how it improves your trading workflow. Thank you for watching. See you in the next video.